Good morning, good afternoon, and good evening, friends. In this class of depreciation, we will look into the other methods that are available for calculating depreciation. One such method, so far we have seen, let's do a small recap. So far we have seen straight line method, then we have seen diminishing balance method or return on value method, then we have seen annuity method, then we have seen sinking fund method, right? Now there are other ways of calculating depreciation also. One such method is machine hour method. Machine hour method, it's pretty much easy and pretty much simple to understand the concept. So as I've been telling, it's good to know what is the concept behind the accounting so that it's much more simpler when we actually do the calculation. So what is machine hour? When it is practical, like we know that the machine, like if the capacity of the machine, let's say, uh, I'll put it here. So when we say that the machine has got a capacity, say around running for 10,000 hours, machine can run for 10,000 hours. Uh, then it can also produce, say, 10,000 quantity during that period. Then how the calculation should happen? Where it can happen based on unit price method, or it can happen based on the machine hour method. Right? When it is practical to keep records of actual running hours of the machine, depreciation be calculated on the basis of hours that the concerned machine has worked. The machine hour rate of depreciation is calculated by estimating the total number of machine hours that the machine would work in its life. However, it may be varied from time to time on consideration of change of the economical and technical conditions, right? Change of economical and technical conditions, etc. Suppose the cost of the machine, let's do a simple calculation. uh, Machine hour method takes into consideration the total life estimate of the machine in hours. Machine in hours, say, like cost of the machine, say 11,000 rupees. 11,000 rupees. And residual value after the life is after the useful life is 1,000. Right? Net cost of the machine is equal to 10,000. Right? And running hours in sense life of the machine. Let me put it life of the machine in hours. Let's say the machine can run 500 hours. That's the total life of the machine, right? So machine hour depreciation is equal to 10,000 divided by 500. So every hour the machine runs, 20 rupees will be charged into as depreciation. However, this is practical, this is possible. This method is possible only and if only if we can keep the records of machine utilization, machine hours. If we can keep the actual running of the machine, then this method can be used. It can still be seen like the machine hour depreciation can change. Like in the first year, a machine can run say like 4,000 hours. 4,000 hours. And second year the machine can run for say 6,000 hours, because the machine has been tuned to the extent machine can run for say 3,000 hours, right? And in third year it can run 2,000 hours. It can run 2,000 hours. So the depreciation will be like total hours is equal to 4,000 plus 3,000 plus 2,000. That's 9,000 hours. assume that the cost of the machine is 2 lakhs, right? So depreciation for year 1 is equal to 2 lakhs into 4,000 divided by 9,000. So first year depreciation will be 88,000. Second year depreciation for year 2 is depreciation for year 2, and depreciation for year 3. Depreciation for year 3. So for year 2 will be uh, 2 lakhs divided by into 3,000 divided by 9,000, and for year 3 it's going to be 2 lakhs into 2,000 divided by 9,000. So the total depreciation that will be charged in year 1, year 2 and year 3 will be this amount, right? So this is how the machinery depreciation will be calculated under the machine hour method. Now, whether this is a more robust method of calculating depreciation, yeah, as we see, like this is used only and if only we have the machine hours maintained accurately. If the utilization of machine is not calculated, or machine hours are not tracked accurately or in any systematic manner, this method cannot be used. Now let's get into the next method, which is called production units method. Production units method. Friends, you have to understand one point, like there can be multiple ways of calculating depreciation. What is more common way of calculating depreciation is diminishing balance method or return on balance method. However, these are all the other methods available, avenues available for calculating depreciation, and some cases they are being used as well. If like machine hours also we saw, right? If it can be used only if the machinery data is used. But however, the it has to be seen like whether the machine will be kept idle, then there will be no depreciation for the year. That is not possible. The major drawback in this method, like, let me add that also here. Major drawback in this method is idle time of the machinery is not calculated at all, right? Machinery can depreciate even with passage of time due to normal wear and tear. So this is never considered in this method, because if the machinery is idle for 6 months, then there is no depreciation that will be charged to P&L. But that is not the right practice for one reason, because there can be idle time depreciation also due to the normal wear and tear of the machinery because of non-usage also. That's not being considered in this method. So this can be helpful only when the machine is running throughout the year, right? Only when the machine runs throughout the year without any hindrance, and the production is also uniform throughout the year, right? So only those cases machine hour depreciation is practically possible. Next, production units method. Here also depreciation is calculated based on units produced. See, for example, the unit production is say 10,000, 5,000, 10,000 something during the 3 years. Like year 1 production is 10,000 units, say 1,000 units, right? Year 2 is 800 units. Year 3 is and cost of the machine is 3,000 rupees. So depreciation for year 1. Depreciation for year 1. Let's put it for 2, for 3. Depreciation for year 1, 2, and 3 will be like is equal to 3,000 into 1,000. 3,000 into 1,000 divided by 3,000, right? Year 2 will be 3,000 into 800 divided by 3,000, and 800 divided by 3000. Here 3 is going to be 3000 into 1200. That's 1200 divided by 3000. So if you see here in this is an interesting one, right? There's a dip in production and depreciation is charged basis the units produced. Whereas in practical, because of reduction in production, obviously machinery idle time wear and tear is possible. That is not considered here. That is not considered here. And also, as with the passage of time, there can be more repairs or there can be, so the production is increased probably because of machine running additional hours or machine running overtime, or there can be multiple reasons. So all those factors are not considered here in this method. In this method, only the total production is considered without considering the other factors. So there can be multiple methods that we can look into. Like we will probably look into the next couple of methods and then summarize the depreciation in one class. But hopefully the students have understood the concept here, right? And let me see, 18 and 19, where we have seen machinery, machine hour method, and then production units method. Please go through this couple of concepts and then let me know any queries or clarifications. And you can reach out to me at babupriya@redifmed.com, or you can also post your comments onto this video. Thank you, friends, and have a great day.